Hello, I'm Toby Cisneros and welcome to Sector Vector, the show where we dissect the U.S. equity markets to look at how the different sectors are performing. With the election under 2 weeks away, U.S. equity markets lacked direction last week, with the Dow, the S&P 500, and the NASDAQ 100 posting modest losses. That despite a very positive start to Q3 earnings season. Thus far, 27% of S&P companies have reported, and 84% of those have beaten earnings per share estimates, well above the 5-year average of 73%. However, despite that, we can't ignore the fact that U.S. companies are recording their second largest drop in earnings since Q2 2009. In fact, only the healthcare and consumer staples sectors have delivered any outright earnings growth in the third quarter so far. Though with 73% of the S&P 500 still to report, perhaps we shouldn't read too much into those stats. There are 3 sectors in which stocks have consistently beaten Q3 revenue estimates: consumer staples, healthcare, and materials. Tech stocks have managed an 85% hit rate thus far, and the energy sector has the worst performance in terms of earnings growth. That said, 67% of the companies in the sector that have reported Q3 earnings managed to beat Wall Street's revenue forecasts. In terms of price performance, the communication services sector was the largest weekly gainer, up by 2.13%. It comfortably outperformed its peers in the wider S&P 500 index, which was down by 0.53% over the week. The clear underperformer among broad-based S&P sectors was information technology, which fell by 2.21%. The sector has, of course, been one of the main drivers of this year's equity gains, adding more than 29% over 2020 to date. The sector finished the week almost 7% below its 3-month highs. The weakness in tech stocks tallies with the fact that QQQ, the Invesco NASDAQ 100 Index ETF fund, saw more than $2 billion of redemptions last week. Interestingly, though, overall the S&P 500 index was a net gainer with more than $3.8 billion flowing into the SPY, the largest of the S&P 500 tracking ETFs. This was reflected in Trackstar IQ, our proprietary search tracking software, which saw a reciprocal pivot in ticker research by Wall Street investors. With political storm clouds and antitrust prosecutions starting to engulf tech stocks right before an election, it's understandable why some investors may be happy to take some money off the table at this juncture. It's worth noting that U.S. fixed income ETFs were last week's biggest winners, with $3.59 billion of new money flowing into the sector. And despite the impressive performance of U.S. equities in 2020, U.S. fixed income has attracted almost 60% more money than U.S. equities over the year to date. Trackstar IQ data shows over a 100% jump in interest in high-yield corporate and treasury bond ETFs last week. If we dig down to an industry level, we find that travel booking and airlines were among the best performers, up by 9.50% and 9.20% respectively. Alcoholic beverages also fared well, gaining 7.90% over the last 5 trading days. The biggest losers at an industry level were retail mail order and direct shopping, which fell 8.10%. Transport equipment manufacturing stocks fell by 5.50%, taking their losses in 2020 to date to negative 29.90%. To learn more about our Trackstar IQ data, sign up to our free newsletter at investingchannel.com/Trackstar. That's all we have time for this week, so until next time, safe trading.